What is the future of cryptocurrency? Contracts between two investors betting on the future value of a cryptocurrency are known as cryptocurrency futures. You may use them to learn more about particular cryptocurrencies without actually buying any of them. Due to the ability to speculate on an underlying asset's price movement, cryptocurrencies futures are similar to traditional futures contracts for commodities or equities. The Chicago Mercantile Exchange and cryptocurrency exchanges both trade cryptocurrency futures. The first Bitcoin futures contracts were listed on CBOE in early December 2017 but soon discontinued them. Early in December 2017, CBOE offered the first Bitcoin futures contracts, but shortly removed them. The contracts are paid in cash and are traded on the Globex electronic trading platform. The CMECF Bitcoin reference rate and the CMECF Ether reference rate serve as the foundation for Bitcoin and Ether futures. Any underlying asset's futures contracts are derivatives of that asset. These contracts are bought and sold by two commodities investors who make predictions about the price of the item at a particular future time. You must adhere to the contract specifications for unit quantity, price, marginal value, and settlement methods. Think about the example below for a Bitcoin futures contract from CME Group. Consider a scenario where a trader buys two 10 Bitcoin futures contracts. When the futures contracts were bought, one Bitcoin cost $5,000, making a total of $50,000 for both contracts. For CME's Bitcoin futures contracts, the margin requirement is set at 50% of the contract value, or $25,000. Leverage can be used to finance the remaining portion of the contract acquisition. The price of the underlying asset, in this case Bitcoin, determines how much the contract is worth. The volume-weighted average price for Bitcoin that is obtained from CME is known as the Bitcoin reference rate. It is calculated every day between 3 and 4 p.m. London time from many exchanges. You have the option of holding onto the futures contracts or selling them to a third party, depending on changes in Bitcoin's price. You have the choice to renew your contracts at the conclusion of their term or let them expire and get the financial settlement that is owed. The procedures for trading a normal futures contract and a Bitcoin futures contract are identical. Creating an account with the brokerage or exchange where you wish to trade is the first step. You will need additional approval from the trading service provider once your account has been approved before you can begin trading futures. The latter clearance often depends on the amount of cash needed and the account holder's background in trading derivatives. The same factors are crucial in establishing your trade's leverage and margin requirements. Leverage is often used in futures trading to complete contracts. The maximum leverage permitted at licensed exchanges and trading venues is governed by government bodies. A separate narrative applies to uncontrolled exchanges. They are allowed to permit taking excessive risks in their deals. In 2019, Binance introduced futures trading on its platform and provided leverage of up to 125 times the trade amount. In July 2021, that threshold was increased to 20 times the trade value. Keep in mind that more leverage results in increased volatility for your trade. Thus, the chance of suffering big financial losses balances the promise of high returns. The amount you have available for margin determines how much you can trade. The amount of margin that must be in your account in order to execute trades. The broker or exchange will need more margin to execute the deal, according to the trade's value. The exchange mandates a margin requirement of 50% for Bitcoin and 60% for trading Ether futures. Futures products from several businesses are offered by brokers, although varying margin requirements may apply in addition to the provider's fees. Brokerages like TD Ameritrade, which provides CME Bitcoin futures, have a basic margin requirement, for instance. In addition to the base rate established by the exchange, margin rates for futures trading might be set as part of their product suite. CoinGecko data show that on July 29, 2023, the following platforms were the most popular for trading Bitcoin futures. Trading Bitcoin futures contracts has the major benefit of providing regulated exposure to cryptocurrencies. In a system with erratic price fluctuations, that is a crucial factor. The Commodities Futures Trading Commission, CFTC, oversees Bitcoin futures contracts at CME. Institutional investors, who make up the majority of traders in such contracts, now have some confidence and redress. The procedure for investing in Bitcoin is also made simpler via Bitcoin futures. Since there is no Bitcoin exchange, you do not need to construct a Bitcoin wallet or employ custody services to store and secure your funds while trading. Eliminating the danger of actual ownership of a risky asset is an additional advantage of contracts with cash settlements. For experimenting with Bitcoin without getting burned, Bitcoin futures contracts are somewhat safer because you can reduce your risk exposure to the asset class with futures contracts positions and price constraints. The position limitations on different exchanges vary. A maximum of 2,000 front-month futures contracts and 5,000 contracts across other maturities are permitted by CME, for instance. Binance has a position limit and is the largest cryptocurrency exchange in the world by trading volume. Limits can be manually adjusted using an adjustment tool based on previous trading activity and margin amounts. As more exchanges start to provide Bitcoin futures trading, more people are participating in it, and more money is being traded in comparison to other commodities. Since cryptocurrency futures trading is still relatively new, it has a unique set of quirks. Cryptocurrency futures trading volumes might resemble those of their spot market equivalent. Additionally, there may be significant price swings, particularly during periods of price volatility. During certain periods, spot market prices for cryptocurrencies may appear to follow them, or spot market prices may trade at a large premium or discount. This indicates that the volatility of the underlying futures market may not be sufficiently hedged by Bitcoin futures. In June 2021, the SEC issued a warning to investors about the dangers of trading Bitcoin futures. Other things include: investors should be aware that Bitcoin is a highly speculative investment, including exposure through the Bitcoin futures market. Options for using cryptocurrencies are a recent development. In January 2020 and March 2022, respectively, CME began offering trading in Bitcoin options and Ether futures options. Because they represent a right to purchase Bitcoin at a certain price at a later date rather than an obligation, cryptocurrency options operate similarly to normal options contracts. Cryptocurrency futures contracts traded at the CME serve as the asset's representation in this instance. Comparable to a single futures contract with 5 BTC or 50 ETH, a single options contract. At CME, there are now options contracts available for 6 consecutive months. If you find this video useful, don't forget to like and subscribe to our channel.